I get asked all the time, how do I start investing in real estate? So I put together this simple 5-step action plan that walks you through 5 steps that will get you on the path to acquire your first rental property like that. I'm launching this 5-part series, so this video and the next 4 videos are going to be the 5 steps that you need to do to go out and get ready to start buying rental properties. As soon as you're done with these 5 simple steps, you will be ready to buy a lot of rental properties. And once you learn these 5 steps, you will have the foundation built ready to buy as many rental properties without using any of your own money as you want. I put together this whole 5-step process for you, so if you appreciate that, please give this video a like. The first step, which is usually the most daunting step, is to get your money right. And what I mean by that is getting everything set up so you have your money ready to buy real estate when the right deal comes across your plate. All right, so let's just rip off the Band-Aid. You need money to invest in real estate. It can be your own money and it can be other people's money. Regardless, you need to use money to buy real estate. It can be as little as 3.5% down of your own money, or you can fund 100% of the project using other people's money. Regardless, you need money, and this is where you go to find it. The first place that I would go to look for money is a private lender. Private lenders are people that invest in you and invest in real estate, but they don't do anything. They're completely passive. Private lenders are just looking for a passive return. They don't want to do the work. They just want to give you the money and let you do the work. Why would they give you the money? Because they're investing in you and they trust real estate as an actual investment. They're giving you the money and you're utilizing it to buy real estate, but then you give them their money back plus interest. It's simply just a passive investment gain for them. I love private lenders because they're the most flexible, they're usually relationship based, and they're trusting and investing in you as much as real estate. They write you a check, you buy the house, you write them a check back plus interest. Private money lenders are the key to all this, in my opinion. At the end of this video, I'm going to point you to where you can find private money lenders. Let's say you don't have a rich uncle named Joe. Well, guess what? You can simply Google Rich Uncle Named Joe Incorporated. I'm kind of kidding, you can't do that, but you can Google hard money lenders, which is exactly what you're looking for. These are companies that their sole purpose is to lend money to new real estate investors to buy real estate properties. They're different than private money lenders because A, they're companies, but B, they're going to loan you the money or not based heavily on the quality of the deal. Yes, they're going to look at you personally, but if it's a really good deal, they're going to lend you the money. They're super easy to find. Simply Google hard money lenders near me. There's local ones and there's national ones. Go to your local real estate investing Facebook groups and ask who the local hard money lenders are, or national ones, and also ask at your local real estate investing meetups. If you do those 3 things, you will have a handful of hard money lenders ready to lend you money. Those first 2 were using other people's money. Now let's talk about creative ways to use your own money. The first is a home equity line of credit, or HELOC. I wanted to talk about this one first because if you own a house, over the last couple of years, it's gone up a lot in value. So there's been a ton of equity created. And equity is the difference in what you owe on a property and what it's worth. Properties have gone up a ton in value, so having a home equity line of credit is basically just like having a credit card on that equity. When should you use the HELOC? Well, first you have to own a house that has equity. It can be your personal house or a rental house. And if you have that equity and you want to use money sometimes, not all the time, that's when I would use a home equity line of credit, because you get an equity line or a credit line on that property and you're not getting charged any money unless you're using it. It's basically just like having a credit card on your house. If you're not using that credit card, you're not getting charged any interest. If you do use it, you're getting charged interest. So it's great to use for little things like maybe a down payment from a hard money or private money lender on a rental property, or maybe the rehab costs on a rehab, or even the points that you're going to be paying hard money lenders if you borrow money from them. Either way, it's a great flexible way to use money in the short term. Another way you can use your own money, and again, I'm assuming you don't have wads of cash, this is fake, but assuming you don't have a ton of real cash, you can sell things for cash. If you have a crazy expensive car or you own something that you don't use, you can sell that and get cash. And if you have cash, you can do whatever you want with that cash. Lastly, a super creative way to get into real estate with little to no money is house hacking. House hacking is buying a house, a duplex, a 3-plex, or a 4-plex, and buying it and living in it and renting out either a room if it's a single family house, or if it's a duplex, triplex, or 4-plex, renting out those other units to other people. You can do this by putting 3.5% down with an FHA loan, or you can put 20% down. There's a lot of different options, but basically you're buying a property and you're using either the rent from the rooms of your buddies or friends or the rents from the other units to pay the mortgage and hopefully a lot of the owning costs. It's a great way to start investing. So let's recap what you can use for money for your down payment, and then we're going to move on to credit. You can use a private money lender, you can use a hard money lender, you can use a home equity line of credit, you can use your cash or sell stuff for cash, or you can house hack. Either way, you're using money, yours or other people's, to get started buying houses. The next biggest obstacle that a lot of people come across is their credit sucks. Let's talk about a few quick ways that you can raise your credit, and then we're going to talk a little bit about loans, and then I'm going to send you to a private money lender. The first and simplest way to get your credit raised quickly is to become an authorized user on somebody else's account. Just because you're an authorized user doesn't necessarily mean that you're even going to have a credit card. You can become an authorized user on your parents' account or somebody you know's account. They can give you a credit card, but they don't have to. Just linking your credit with their credit will help raise your credit. And obviously, I'm assuming that you're going to become an authorized user on somebody's account that has really, really good credit. The second way is to get a secured credit card. All the major credit card companies have them, but basically it's like a prepaid Visa card. For simple math, you load this credit card up with $500 worth of cash at the beginning of the month. Then throughout the month, you buy things that you would normally buy anyway, and you get that paid down to zero. And then the next month, you load it up with $500. It just shows the credit bureaus and credit card companies that you're able to stick to a payment plan and stick within a budget. The third way to improve your credit quickly is to work on your utilization rate. So if you have a $10,000 credit limit on your credit card, use 30% of that or less. The less you use, the better. This shows credit card companies that you have access to $10,000, but you only need to use a couple thousand or less. The last way would be to dispute your credit or ask for forgiveness. You can do this yourself, or you can hire a company. But what they do is they write a letter to the credit bureaus and they try to dispute something on your credit card, or they ask for forgiveness, and a lot of times it works. Now that we got your down payment figured out and your credit going in the right direction, let's talk about some long-term funding and what banks look for so that you can get approved. All banks are different. They're all going to look for slightly different things. These are the four main things that banks are going to ask for when you're applying for a long-term loan. So what you're going to want is a pre-approval letter saying that pending the deal and the bank's underwriting, they will fund you the money for the long-term investments. That's how rental properties cash flow. You get a mortgage from the bank with a small monthly payment so that your rent covers the mortgage plus all owning expenses, and usually want some positive cash flow on top of that. So you're going to want to get a pre-approval letter from the bank so that you can go out and make offers on properties and know what the bank will and will not fund. So what are they going to ask for? They're going to ask for four things. The first thing they're going to look at is your personal credit score. Even if you're buying it in a business, if it's your first loan or your first loan with that bank, they're going to want to look at your personal credit. That's why a couple minutes ago, I told you what to do to get that raised. The second thing is they're going to look at your income. They're going to look at pay stubs, and they're going to want to see consistent income coming in every single week for at least 2 years. And piggybacking off of that 2 years of income coming in, they're going to go back and look at 2 years of tax return statements. And number four is they're going to want to see reserves in your checking account with them, preferably, but if not, with a different bank. It doesn't need to be a ton of money in reserves, but they just want to feel secure that if something does happen or your renter leaves, they're just going to want to have some security that if something does happen or your renter leaves for a few months, you do have some cash reserves to stem the tide. Those are the things and the ducks you're going to have to start to get in a row to get the long-term funding. In the next video, I'm going to talk about knowing your numbers so you know a good deal when it comes across your plate so you can act quickly. As promised, if you want to know how to find a private money lender, click on this video above. I have several on this channel, but this is my favorite. It walks through where and how you can find private money lenders so they can fund your deals. Also, if you have any interest, check out the description below, because in my mentorship now, we have a national private money lender that lends in all 50 states and that will lend close to 100% of purchase and 100% of rehab. So if you're interested in learning more and getting a private lender handed to you, check out the description below, click on the free training, and you can talk with my team about the mentorship. If you saw any value out of this video, if you have not yet, please hit that like button. Make sure you're subscribed to this channel for more great content. We got your down payment right, we got your credit right, and we got you talking to banks right. So guess what? We got your money right. See you on the next one.